Hello everyone, today we have the S&P 500 on the daily chart and we have the volume profile of the last week. Now we have this huge red candle that's minus 1.8%. So some people may think if there is a huge red candle like this, then the next one might be bullish. This is super wrong. And if we come back to the statistic of the S&P 500, okay, let's update the COT data. Anyway, what can we have here on the return distribution? We have the two standard deviation is at minus 2.3, so it's not undervalued yet, and it can get even down because of the seasonality and the geopolitical tension. As we can see over here, even in the volatility from the high to the low, it's minus 2.7, which is okay. The volatility, wait, I think I made something wrong over here. In volatility there is not there there is no negative number because it's always from the low to the high, so this is all we need, and those data were wrong. So in volatility the plus 2 standard deviation is at 4%, and in here it's 2.7, so it's not undervalued yet. And we have bearish seasonality, so what I'm going to look for the next week is to go short. Let me just check the CLT data. I think, let me just, okay. So the net commercials are buying, the large speculators are shorting, and the retails are neutral, as you can see over here. What does this mean? The CLT data gives you the bias of the first 2 days of the week, which are Monday and Tuesday, and they were buying, but not too much. If we come back to the CLT, we can see the net commercials. Of course, in CLT we follow the net commercials, not the large speculators. Anything that's related to the dollar, we follow the net commercials, like the USD and the indices, and anything other than the dollar, like the euro, the Australian dollar, let's say the pound, the gold, all the commodities, we follow the large speculators. But exceptional rule for anything related with the US dollar, we follow the position of the net commercials, and we can see that they are bullish. So we have bullish seasonality plus bullish net commercials plus bearish net retails equal bullish. But in this time we have bearish seasonality from Monday to Tuesday, and we have bullish net commercials and bullish net retails. So this is like mixed CLT data. And now I'm gonna use the geopolitical tension because, as I told you, news are more than the seasonality in the short term. But lucky for us, the seasonality is aligning with the geopolitical tension. So why the S&P 500 is going down? Okay, Israel attacked Iran, but what does it do, or why it's affecting the US market. It's not, some people might think there is no relation. Now let me give you something. If I have $10, I was, let's say, investing $8 on the S&P 500. Then geopolitical tension is there. So what can I do? I need to buy gold. I'm not going to buy gold with only $2. I need to sell some of this S&P 500 to go buy the gold. So I'm going to sell like $3. So I have now $5 for gold, because I know the gold has a very high chance to make, let's say, a large percentage of return. So this is why I'm going for gold and not the S&P 500. And this is why this happened. So people was shorting not because the US market is weak, but because they want to buy gold, and especially oil, because Iran is one of the best positions. Let's say the Iran country is positioned in a very sufficient place where they can control like 20% of oil movement daily. I can't, there is something, I want to say it, but I'm not that good with English, so you understood that they control over 20% of the daily oil, and this is why price can go to over $100 easily. Now we have this cluster over here. So what I will wait, okay, let me show you something. I'm showing you this every video, but okay, it's not something that takes so much effort. This is our volume profile. This is it. On the edges there is this low volume nodes. So on the edges we have those. Those are the best key levels, so they can act as a support and resistance. So when price was here, then breakout from here, what I can expect? A retest from this area or this area. Of course, if price went to retest here and there is no liquidity, price can go all the way over here and then go down. But this is a very, let's say, it doesn't happen too much. It happens in very rare situations. Let me give you an example. So if everyone want to short at this level, there is no one to buy the contracts. So this is why price will go over here and then go down. For example, like this one. So price, this is our level we're talking about. So price break through it. I was waiting for retest. Okay, there was slight retest, but there was not enough liquidity. So price went, when there is this heavy volume, price wasn't chasing for retails stop loss. Price was looking for liquidity. Price was going to go down, but there is no one to buy their contracts. This is how institutions think. If there is no one to if you can't find anyone to buy your contract, you can't really sell it. So this is why price or institutions always look for price or spaces where, or zones where there is liquidity. As you can see, price was looking here and then went straight down. Even with this, it wasn't a sharp move because there wasn't enough liquidity. Everyone was shorting. So if most of the people was going short, then who's going to buy the contracts? This is the big issue. But I'm going to consider there is enough liquidity over here, because there is this mixed sentiment. So most maybe some institutions will provide some liquidity over here, so we can go short at this level, exactly at this level. And where to put to put my stop in the strongest available rejection, which is at this case over here. But this is too much because I don't price, or in my case, in my point of view, let me just think how I'm gonna say it in English. So if price is going to back over here, it means it's looking for liquidity. And when I see price just going over this area, I know there is no liquidity to go in a short, sharp move. So I will just close my position. So I won't extend my stop just over here. I will put it just above those rejections over here. And what I will target this move where there was some rejection, or the rejection started really making sense, then price went up. So this is where I will target, and it aligns with this cluster over here where price might find some liquidity. So it's a goal for institutions. If you understand what institutions are doing, rather than blaming them for chasing your $5 stop loss, you can do so much better. So this is my idea for you, but okay, this is one position I will take. And if you want something advanced, you can go to my playlist, The Truth of Trading. Go to episode 4. There is one introduction, then 5 examples. In those 5 examples, I think we got 1, 2, 3, 4, 5, 6, 7. I think we got about 7 positions, or 6 positions, as I guess, and we got 66.6 win rate. 1 break even, 1 stop loss, and the rest were 2 stop loss, and the rest were wins. If you want something advanced, of course, something related to footprint, bookmap, where you see sell orders and real volume, not tick volume like this. So this is my position for Monday or tomorrow. Thank you guys for watching. I hope you understood my I feel like I'm a philosophy teacher, but anyway, thank you guys.